This is Rod Kusanen, Spooman for Risk International, announcing our indicators are now available for discretionary trading. One of the primary indicators we use is the ESJ indicator. It can instantly calculate multiple studies from any data feed on any interval. It simultaneously calculates 7 different studies, including the Zurich MACD, CCX, and stochastics, as well as Z-score, Z-score divergence, automated Fibonacci retracement and extension lines, and we also include our volume divergence indicator, and our famous gap finder. Now, incidentally, when we're talking about Zurich, we are speaking about actual Zurich algorithms. And if you don't know anything about them, go to zurichres.com for further information. Why is our indicator so useful? It's because we can now take the results of those calculations and send them anywhere. We can plot any study on any data feed on any interval. So for example, we could take a 100 ES tick chart and we can put the VIX, the tick, the MACD of a larger tick interval off of the ES, superimpose the Z-score of the premium, and add our Fibonacci retracement and extension lines all on the same chart. It could look something like this. Here we have multiple Zurich stochastics being plotted on a 100 ES tick. This chart superimposes the stochastics of a 50, 100, 500, and 1000 ES tick chart, along with 3 different intervals coming off of the large contract as well as one off of the NYSE tick. All of that being placed on the same chart so that as the trader, you can line things up and increase the probability that when you enter the trade, you're at a nice position to profit from the advancing move. Here's the CCX indicator. 5 different CCX indicators, all coming off of anything but the ES 100. We've got them coming off of the large contract, 3 off of the NYSE tick, and 1 even off of the VIX. You line it up, good opportunity for a long trade. Let's take a look at the Z-score. Z-score coming off of a 300 tick bar ES, a 10 tick bar from the NYSE tick, the large contract, and even the premium is included. And by lining up those Z-scores, you see a good opportunity for a short trade. So now when you combine the versatility of this indicator, the ability to take data from any data feed and plot it on the same chart from which you're trading, you're now able to create your own strategy. There are any number of different configurations available to allow you to design your own strategy and look for much better trading opportunities. Now let's move forward and talk about our Fibonacci retracements. These are automated. This indicator automates the drawing of the exact Fibonacci retracements. Now that's no small statement, because if you try to draw a Fibonacci retracement, you number one have to locate your pivots, you have to locate your highs and your lows exactly, and then you have to draw your line. Well, all of that takes time. We do it automatically. All you have to do is just simply know what the definition is of your pivots. And once you know that, the indicator does the rest without the touch of a button. So here's how we could use that. The indicator shows a retracement down to the 38.2% level. Well, at that very time, we see two different forms of divergence emerging. We see a low on the stochastic as well as the CCX, and a good opportunity to take a long trade. All of that happening automatically for you. So let's say you take this long trade. What are you going to do next? Well, the next thing is to look where you're going to take your exit. Fibonacci extensions can be used as profit targets. The first level, 38.2, turns out to be at the 1257 price line. We see weakness in the indicators and a good opportunity to take your profit. At least your first one. Maybe you're trading multiple contracts, so you take a little bit off the table and leave the rest for perhaps the next Fibonacci retracement. Or pardon me, extension line. All of this happens automatically. Let's look at another example. Here we're going to use, once again, Fibonacci extensions with our volume divergence indicator. Now, in the last subgraph, you see a yellow dot appearing where divergence exists. That divergence being defined as the ES hitting a higher high and volume hitting a lower high. That divergence, in conjunction with stochastics and the CCX indicator at a known Fibonacci extension level, indicates for us the probability that the market is liable to turn. So we take our profits, we maximize them, and look at that potential. If we were so fortunate to have gotten in right around that 12, 24, 25 level, we've got over a 10-point move that we've profited by. Now, let's move forward and let's talk about one of my favorite subjects, the premium. Few traders know anything about the premium, let alone how to read it. Until now, we have never found an indicator that could do that automatically, but now comes Z-score. Our study of the Z-score indicator demonstrates to us that it is the only one we know of that can actually read any premium feed accurately. And it's really simple. All we do is look at the Z-score in relationship to the zero line, Z-score being a function of standard deviation. So when the Z-score drops below zero, we're short. If it goes above zero, we're long, and it's just that simple. So we take this information off of the premium, and then we send that data onto our trading chart. Here again, 100 ES tick. Now you see the same Z-score being run off of the premium. As the Z-score drops below zero, that's the yellow line, we're short. It goes above the zero line, it's green now, it's long. That's telling us where to take a long and a short trade. Now you can use additional data to confirm those trades, but this could make for a very effective trading strategy without adding anything else. Let's move over to our volume send indicator. Now, without going into a lot of detail on how volume is calculated here, suffice to say that when the histogram is green, volume is increasing. When it's red or a shade of red, it's decreasing, and we can see a corresponding move in the market. We're plotting the volume indicator on a 1,000 ES tick. As you see, the red bar there is at a lower high, so that we see some reason to think that perhaps this market's going to drop and we should take a short trade. But to confirm that, let's now take a look at the exact same time on a different tick interval. Let's look at a 300 share bar. During that same period of time where the volume bars were above zero on the 1000, you can see that in fact they were below zero on the 300 share bar. There's really nothing holding this market up. Good likelihood that this market's going to drop off. So what we'll do now is we'll take that data and we'll send it over to our primary trading chart. So in the middle of the chart, you see the same volume data that's being placed upon this 100 ES tick bar chart. You combine that with 4 different z-scores using different intervals, different data feeds, including the premium in this case, and you see good reason why you ought to take a short on this position. And it works. Now let's move over and talk about the gap finder. You may not feel that gaps are particularly useful. Well, think again. You're about to see how we use the gaps to confirm the Fibonacci retracements and to increase our confidence in where the market is going to go. Now, the gap line in this particular case is that green line toward the bottom of the screen at a price of $12.50.25. Now, you don't know where the market's going from here, but as time moves on, you'll notice the market is now rallied up. But now notice the time. The time is after the close. We're in the after-hour market, and the market is still moving. So for those of you that like to play the after-hour market, there's very few market internals that you can use to confirm what direction the market's going to go, because all you've got is a price-based approach to things. But when you add the gap information to it, you can substantially increase the likelihood that you're trading in the right direction and making a good profit off of your decision. So now, as it turns out, the market moves up to about 12.57 in the after hours and then begins to retrace. Well, we already know that there's a gap down there at 12.50.25. The closest Fibonacci line is at the 88.2% level. Now, what actually takes place is the market moves down into the open of the New York Stock Exchange. It moves all the way down and fills the gap, and then drops just a little bit more to exactly the 88.2% level, stops, turns right around, and starts to rally back up. That was an 8-point drop. And if you were playing that game, you no doubt could have taken advantage of a good portion of that. Gaps can confirm Fibonacci retracements as well as extensions. Let me give you another example. Now here we find a gap. Again, this is the after hours. And by the way, you put our gap indicator on any data feed, it will instantly find every existing gap. The gap lines are drawn in real time, and they stop when the gap is filled. So all you have to do is just take the data, look at it, see where the gaps are, see where the market is, run some calculations, and have a fairly good idea of what's about to happen. Well, now right now you don't know what direction the market is going. But given a little bit of time, here's what occurs. The market is dropped from 1249, the high in the after hours market, and moves all the way down to a low for the morning at 1223, and now begins to turn, pivot, and start going back up. Well, where's it going to go? Well, if you run that retracement between the high and the low, and you look at where the gap is, which is at 1241, the 76.4% retracement line is closest to that gap. In fact, it's a little bit higher. So if you were able to capitalize on that low, between the low and where the market is likely going to go, that's a 20-point move. I'm sure you could take at least a portion of that and put it into your P&L. Well, now what actually happens? Sure enough, the whole day goes by, and that gap is filled in, once again, the after-hour market. It gets filled shortly after 2 a.m. But that 20-point move that we were predicting is in fact achieved. Gap fills really do work. They really, really work. Here's another example. Market has moved up, begins to move down, leaves a gap at 1246.75. Now, in reality, the market moves down and ricochets off a 61.8% retracement line. The golden ratio is hit, market flutters for a bit, and then begins to move back up. Well, where's it going? 2 hours before it occurs, you know that the probability is very high that that 1246.75 gap is going to be filled. And sure enough, it does. So between the high and the entry price, you stood to make 5.5 points, or at least a portion thereof. Gaps can confirm Fibonacci. Now, if you're so fortunate to be watching this video at or before the last week of the trading year of 2011, please take very close note of what we are about to show you. On Friday, December 23rd, 2011, the market rallied up to a high of 1260.75. It had come off of a low on 1222 of a price of 1232.25. Now, a 50% retracement between that high and low would bring the market back down to about 1246.50. Now, would you short that? Our traders will. You want to know why? There's a gap at 1244.25. On 12/22 of 2011 at 11:07 a.m. Central Time, that gap was formed. So that 50 to 61.8% retracement is now pretty likely, because gaps are always filled. So from the high down to this retracement level, or at least that gap fill, that's approximately 16 points. And on just one contract, that's $800. Can you ignore that? Well, guess what? It gets even better. If you look at the low on 12/21, which happened to have occurred at about 11:30, the price at that time was at 12/23. Market moves from that low all the way up to 1260.75. So a 76.4% retracement would bring the market down to about 1232. 88.2% retracement brings it down to about 1227. Is it likely? Yes. You want to know why? Because there's a gap at 12:30:25. It formed on the 21st at 13:35 p.m. Central Time, and that gap is going to be filled. Now, if it so happens that the market continues to rally up, the difference between wherever the market winds up being and this gap fill is going to result in a retracement that is likely going to exceed 30 points. So on just one contract, that's a $1,500 profit waiting to be had. So now what are you going to do? Well, above all things, we want to recommend get a copy of the indicators we're now making available to the public. Order now at the incredible sale price of just $7.99. Give us a call. Ask for a demo. Ask any questions you want, but by all means, get a copy of our indicators. You will be glad you did. This is Rod Kusin and Spooman for Risk.